Hello guys, welcome to the accounting channel. In today's class we are going to discuss accounting equation and transaction analysis. So let us begin. First of all, we shall define accounting equation. Accounting equation shows the relationship of assets, liabilities and equity. You can see here this is the main accounting equation or the basic accounting equation, which is assets is equal to liabilities plus equity. So it means if you add the liabilities and equity, you will find the sum equal to the sum of all the assets. This is the basic accounting equation. From this accounting equation you can also derive the other equation like liabilities is equal to assets minus equity. This is the other equation that you can derive from the same equation, the basic equation. Or you can also say that equity is equal to assets minus liabilities. So out of the three component, if you know the two component, the third you can get easily by putting into any of the three equation. But remember that the first one is the basic equation and this is called the accounting equation. The other two equation have been derived from the first equation. Now the basic accounting equation, as you know, is the assets is equal to liabilities plus equity. We can expand this accounting equation. How? Because in equity we include some more items, so equity can be expanded. So the expanded accounting equation will be assets is equal to liabilities plus in equity we can have the two parts, the contributed capital and retained earnings. So instead of writing equity we can say here the assets is equal to liabilities plus contributed capital and retained earnings. These are the two parts of the equity. Now the retained earning can also be broken down into the three parts. Contributed capital means the common stock and the retained earning is the amount that you get after making the adjustments of dividend, revenue and expenses. So revenue minus expense minus dividend will be the retained earnings. Revenue minus expense minus dividend. This will be the retained earnings. So revenue minus expense, you know that it is called net income. Net income. So we can say that net income minus dividend is equal to retained earnings. Now see the components of the accounting equation in detail. The first item in the accounting equation is assets. Assets are the resources owned and controlled by a business organizations. Various examples of assets are cash, account receivable, notes receivable, prepaid expenses, land, building, equipment, vehicle, stores, supplies, goodwill, patent, trademark, copyright, etc. Cash. Cash is the company's cash balance. Whatever company or the business has cash as a balance, it is considered as cash. We write cash. And in cash we include money and any other medium of exchange that a bank can accept for deposits. So cash includes cash as well as any other things that is acting as a cash or acting as a medium of exchange. So it may consist of the coins, it may consist of the currency, notes, checks, money orders, etc. All these are the various forms of cash. Account receivable is the promises of payment from customers whenever the goods sold on credit. So in case of credit sale, you do not receive cash immediately. In case of credit sale, you will receive the amount in on a future date after few days. So until you receive the payment from your customers, the amount which is due to be received from them is called account receivable, and it is an asset. The account receivable arises because of the credit sales. There is no question of account receivable in case of cash sales, because in case of cash sales you receive the cash immediately. Note receivable is also to some extent same as the account receivable, but there is a little difference. In case of the account receivable you do not receive anything in writing, you do not receive any document. But in case of the note receivable you receive some document in the written form from the customers or any other entity that have promised to pay the amount on a different future date. So note receivable will be a written document promising that you will receive some amount in future. Next, prepaid expense. Prepaid expense is the amount that you have paid in advance for future expenses, because there are some expenses which are paid in advance for the next year, like insurance premium. The most common example of prepaid expense is the prepaid insurance, because the insurance is generally paid for 1 year, 2 year, 3 years. So when the insurance is paid and a part of the insurance premium belongs to the next year, it means that amount will be considered as the prepaid expense. Next is supplies. Supplies are also the assets until they are used. So whatever supplies you have purchased, it is in the business. Until they are used, they will be considered as assets. The supplies can be office supplies and store supplies. Office supplies includes stationery, paper, toner, pens, etc. Store supplies means the packaging materials, plastic, paper bags, gift boxes, cleaning material, etc. So depending upon the nature of the business, you can have the store supplies and you can have the office supplies. These are the some common things that are generally used in a business organization. Land. Land includes the cost of land owned by a business. Building. Building includes the factories, factory building, office building, warehouses, etc. Equipment. Equipment can be office equipment. Office equipment may include the office computer, printers, desks, chairs, shelves. These are the office equipments. The other type of equipment can be stores equipment. Stores equipment may include counter, showcases, ladders, etc. So all these are, whether it be office equipment or it be stores equipment, all these are the assets of a business organization. Now come to the second component of accounting equation, that is liabilities. Liabilities are the claims made by the creditors against assets. So any amount that you have to pay in future that is due but you have not paid and the creditors are claiming upon your assets is the liabilities. Liabilities are the obligations to transfer the assets or provide products or services to the customers. So if you have received any amount in advance from the customer, so you have to provide products or goods to the customer. So until you provide goods or services to the customers, this will be your liability because you have received money from him. Similarly, if you have purchased any assets on credit, so in that case also, until you make the final payment of the assets purchase, it will be your liability. The amount that is due and to be paid will be your liability. Examples of liabilities include account payable, notes payable, taxes payable, wages payable, unearned revenue, accrued expenses, etc. So you'll see that most of them are the payables. Payable means the amount which is to be paid, which has not been paid so far. In future you will pay it. So let us see in detail. Account payable is the oral promise, oral or implied promises to pay later. So in future you are going to pay, so unpaid amount will be your account payable. Why you have to pay in future? Because you have made some purchases on credit. If you have made the purchases of supplies or purchase of equipment, purchase of any asset on credit, so in future you have to make the payment. It may include the purchase of merchandise, supplies, equipment or services. Notes payable is like same, but the difference between account payable and note payable is that in note payable you give something in writing. So the written promise to pay later will become note payable. It comes in case of the borrowings. If you borrow any money from the bank or any other financial institutions, so this liability of loan, this liability of borrowings will be called notes payable. Unearned revenue. This is unearned revenue, revenue which is not earned. So what is the revenue that is not earned? Any amount that you received in advance from customers for delivery of goods or services will be unearned revenue. You have received any amount from the customer in advance and you have not delivered the goods. So until you deliver the goods, the amount received in advance will be considered as unearned revenue. The examples of unearned revenue you can find in case of the sports club. Sports clubs sell the tickets of the matches. before the match to be held. So until the matches are held, the amount collected by sale of tickets will be considered as the unearned revenue. When the matches are held, all the unearned revenue for that match will be converted to revenue. Accrued expenses. Accrued means outstanding expenses or the expenses which is due but not paid. It is possible that while making the final accounts or closing the accounts, there may be some amount which is due but not paid. For example, the taxes are due by the end of the month but you have not paid. The wages are due to the workers but you have not paid. The salaries are due to the employees but you have not paid by the end of the month or by the end of the year. So any amount which is due and you have not paid is called the accrued expenses, and this is also your liability until you make the payment. Now come to the third component, that is equity. Equity is the owner's claim. Owner's own claim upon the company's asset is called equity, or you can also call it shareholders equity in case of the company. Equity is equal to assets minus liability. I have also shown this equation in the beginning by deriving from the main equation. This is the reason equity is also called the net assets or residual equity, because whatever liabilities are deducted from assets, the remaining or the residual is called equity. So we call it as the net assets, or we also call it the residual equity. Now come to the next part of our discussion, that is transaction analysis. First of all, we shall define the transaction and events. Business activities can be described in terms of transaction and events. The transactions refers to the exchange of values that yield changes in the accounting equation. So transaction will be resulting in the changes in the accounting equation. The values of assets, liability and equity will change because of the transactions. There can be two types of transactions: external transaction and internal transaction. External transactions are the transactions between the business entity and the outsiders that will also be changing the values of accounting equation. The example is sale to a customer. Customer is an outsider. Purchase from supplier. Supplier is also an outsider. So these two are the examples of the external transaction. Internal transaction is the transaction that occurs within the organization, and this also affects the accounting equation. The example is payment of salaries to employees. Salaries are paid to the employees and employees are within the organization. So this example is the example of internal transaction. Now come to the events. What is events? Events is the happening that affect the accounting equation. The happening can be the changes in the market value of the assets. The happening can be floods. The happening can be fires. So these are the happenings. This will happen, and because of this there will be changes in the accounting equation. If there is a flood, so supplies may be destroyed. If there is a fire, the supplies or the machinery may be burned to ashes. So because of these floods, fires, change in the market value, there will be a change in the accounting equation. So we have also to see the transactions as well as events for their analysis. Transaction analysis is defined as the process used to analyze transactions and events. How can we analyze the transactions and events? We can learn with the transaction analysis. So how to do? I have created the 4 steps for your convenience. If you follow these steps, you can easily do the transaction analysis. First step, read all the transactions carefully and pick the items from there. If you are given the question of the transaction analysis, you must be given some transaction. So what you have to do, from each transaction try to pick the items belonging to the assets, the item belonging to the equity, the items belonging to the liabilities. You will pick them. For example, there may be the involvement of cash, so cash is an item. There may be account receivable, so account receivable is an item. There may be common stock, so common stock is an item. Similarly, you have to take all the items from all the transactions. Okay, then come to the next step, classify those items as under the any of the 3 heads. The items may belong to the assets, the item may belong to the liabilities, and then the item may belong to equity. Some of the items that you have taken at the step 1 may be the assets. Some of the items that you have taken from the transactions may be the liabilities, and some of them may be equity. So keep in your mind that these are items that belong to asset, this belongs to liability, and this belongs to equity. Now come to the third step, make a table of accounting equation. In this table, first prepare the three major columns. In the three major columns, the first column will be the assets, the second column will be liability, and the third column will be of equity. Under the three major column, make the different columns of the items that you have found and classified at step 2. At step 2, you have classified several items under assets, some items under liabilities, and some items under equity. Suppose if you find 3 items under assets, so make 3 columns under the major column of assets. Suppose you find 2 items of liabilities, so make 2 columns under the head liabilities. And for equity, you can also do the same thing. Now, after the third step, come to the step 4. Take the question and start from the first transaction. Take the first transaction and see what are the items in the first transaction. Now check whether these items are increasing or decreasing. If any item that is increasing, go to that column and write as the plus. If any item of the transaction is decreasing, go to that column and write as negative. That's it. Finally, you will find the ending balance of all the columns. The ending balance of all the columns will be showing you the accounting equation at the end of the month. So let us begin with the one example. The examples I have given here with the 5 transactions, or there can be more than 5 transactions, but I have given it under the 5 points. The first one is that Abraham Incorporation started a business by issuing equity shares of 10,000. So issuing equity share means common stock. Okay, so one item is common stock. Borrowing money means notes payable. If you are borrowing, it will be note payable. And the third item will be cash, because in both the cases there will be an involvement of cash. Purchase supplies. So here we have one item as supplies. Okay, for cash, the another item is cash. Cash already we have made, so cash has come again. If any item comes many times, you will have to make one column only. 3,000 on credit. So there is a purchase on credit. Purchase on credit means accounts payable. So another column will be accounts payable. Sold supplies, we already have a column of supplies here. The selling price of supplies is 1,200. So here the supplies was purchased for 1,000. Supplies costing of 1,000 was sold at 1,200. It means there is a gain of 200. So for gain, this is another item, that is gain. Gain will be written under equity, under the head revenue. All the gain, profit and revenue are written under the head revenue only. The fourth point is sold supplies. So supplies again is an item, but we don't have to create another supplies. One supplies column is enough. But at a loss. Loss is an item of the expense. So loss will be shown under the equity as an expense. Electricity bill is also an expense. So you have made the column of expense in equity. So this will be going to the expense column. 400 paid yani cash. So cash already you have prepared in the beginning. So in this way these are some columns. Now the second step is to classify common stock. See the first one. Common stock comes under equity. So this is an item of equity. Okay. The notes payable comes under the liability. So this is an item of liability. And cash is an item of asset. Okay. So I have classified. Now here supplies comes under assets and the accounts payable comes under liabilities. Then supplies also is here. We have done it. So no need to do it again. And there is a gain. Gains comes under equity. Okay. Then losses has been shown as expense and it comes under equity. Then expense is also coming under equity. Cash is an asset, we have already made it. So in this way we find some items of the assets. Under the assets we get how many items? Under the assets we get cash. We get cash as an asset. We get supplies as an asset. And What are the other assets? Two items only assets. Two items for the liability. One item is the notes payable, and here is the accounts payable. Two items for liability, 1 and 2. For equity we have one item equity and one item here we have equity, and here the common stock we have. So three items for equity. So in this way we have found the items and we have also classified them. Now come to solve it step by step. Because of the lack of space, I will solve it one by one in different slides. Taking the first, we make the table. Assets is the major column, liability is another major column, and equity is another major column. Under the assets we have found the two columns, so we have made the two columns here. Okay, one for the cash and second for the supplies. Under the liabilities we found the two items, so we made the two columns, accounts payable and notes payable. Under the equity we found the three items, so we made the column for three items, the common stock, revenues and expenses. Now the first transaction is issuing equity, yani increasing common stock by 10,000. So write in the common stock 10,000, and borrowing money means the notes payable increasing by 5,000. So write under the notes payable 5,000, and 10,000 will be coming to the business as cash by issuing common stock. 5,000 will be coming to the business by getting or borrowing from banks. Yani a total of 10 and 5, that is 15,000 will be coming to the cash column. So you can see here that total of asset 15, whereas total of liabilities and equity is also 15. You can see here. The next item is the purchase supplies of 2,000 for cash and 3,000 for credit. So there is a supply which is purchased for 2,000 and 3,000, yani 5,000. So go to the supplies column and write 5,000 supplies plus, because it will increase. 2,000 you are making a payment of cash, so 2,000 will be deducted here, 2,000, and 3,000 you are not making payment, so it means this is an account payable. So write 3,000 in the accounts payable column. Sold supplies of 1,000. Supplies of 1,000 have been sold, yani supplies will be reduced by 1,000. So 1,000 has been deducted from supplies, that is why it is negative. You are selling it for 1,200, yani you will get cash 1,200. So increase cash by 1,200 here, and there is a gain of 200 by selling this at a profit of 200. So 200 profit will be shown in the revenue column. The difference 200 will be shown as a profit. 1,200 minus 1,000, that will be 200. So this 200 is as a profit which will be shown on the revenue. The next, supplies of 500 sold. So 500 will be deducted from supplies. Okay, you are selling at a loss of 100, so loss comes under the expenses. So go to the expenses and write 100 as a loss, negative. You are selling at loss of 100, yani 500 minus 100. So you are getting 400 only. So 400 cash will be increased. So go to the cash column and increase 400. The next is electricity bill. This is an expense. So 400 will go to the expense column. Because of the expense your equity will decrease, so it is negative, and you are paying cash. So this is cash. Cash will be deducted in the cash column, 400. Now we don't have any other transaction after the 5. We shall make the sum of all the items of cash. So making the sum we get 14,200. Making the sum of this we get 3,500, and the accounts payable has only one item, notes payable one item, common stock one item, revenue one item, and the sum of these two items is minus 500. So if you find the total of assets, total of liabilities and total of equity, and check whether the total of assets is equal to the total of liabilities and total of equity or not. So let us check with the next slide. Yeah, total of assets becomes 17,700, total of liabilities become 8,000, total of equity become 9,700 by making all the three. Okay, So if you check 8,000 plus 9,700, this is equal to 17,700. It means we have done everything correctly. That's all for today. If you like the video, please hit the like button and share it to your friends. If you have not subscribed my channel so far, please subscribe it. For more videos, you can also write in the comment section. I'll be happy to prepare the videos that have been suggested by you. Thanks for watching. See you inshallah next time. Till then, good luck. Bye bye.